Hi, and welcome to this video series, Pricing for Profit, brought to you by Community Futures Parkland. My name is Verna O'Neill, the founder of VLO Business Solutions, and I'll be walking you through a number of important topics that are all related to setting the right price for your business product and service offers. By understanding your costs, learning more about pricing strategies, and ensuring you have important information at your fingertips, you'll be able to set prices to achieve your profit goals. Before we get too far, I'd like to tell you more about Community Futures. Did you know there's likely a Community Futures close to where you live and do business? There are 16 offices that cover rural Manitoba, so check out your nearest location. The CF staff are in your corner with loans of up to $150,000 to help entrepreneurs start, expand, or purchase a business. They have advisory services and business training as well, plus other entrepreneurial supports. They are really outstanding at what they do and want to see your business succeed. Okay, let's get started on our video topic, pricing for profit. And here's what we'll cover in this pricing video series. All of these topics are important to establishing a pricing strategy and achieving your profit goals. We'll start with some fundamentals and discuss your company's cost structure, looking at fixed and variable costs and their impact on your pricing decisions. Then we'll focus on break-even points and how to figure those out. Next, we'll discuss the concept of business value and how your market impacts your pricing. We'll also look at the competition and the role that they play in our efforts to set the right price for our products and services. Lastly, we're going to be examining the two pricing models that you can use in your business to create how your pricing blueprint will roll out, making sure that your business is profitable. Okay, here we go with the next video, Chapter 1, where we will take a look at understanding those business costs. Hello, and welcome to the first chapter of Pricing for Profit. If you're looking for ideas on how to set that price for your product or service, you're not alone. It's a common conversation I've had with so many entrepreneurs, especially over the last few years. You may not feel consistent in your pricing strategy, or you may not be confident that you're charging the right price. Maybe you fear that customers will be reluctant to pay the prices you've set. They're all rational thoughts and all valid concerns. Increased inflation, supply chain issues, supply substitutions, labor challenges, and increased competition. These factors and more impact prices and profit. Examining your pricing strategy is an important step to take. Looking at this topic head on, knowing where you stand financially, and then feeling confident about your prices, that's all crucial to running a sound business. This video series and the accompanying worksheet will help you with your important pricing for profit decisions. There are a number of pricing models and strategies out there, and the place I suggest to start is with understanding your company's own costs. Fundamental to great pricing is that you ensure that you're really covering the costs of doing business. So if you aren't sure what to charge your customers, a closer look at your company's fixed and variable costs are definitely in order. You'll see these terms on the screen, fixed and variable costs. Fixed costs remain consistent and must be paid even if you don't make a single sale in the month. Costs like insurance, office supplies, cell phone bills, administrative staff salaries, these all qualify as fixed costs. Variable costs change directly with the number of products sold or produced, like direct labor costs, raw materials, packaging, or freight costs to bring your inventory in. Understanding these two cost categories is important in developing a pricing strategy, and it's the starting point to our work on pricing. Now, the next question is, if these costs are so important, how do you determine them? And where do you find fixed and variable costs? Well, open up your bookkeeping system and generate a few of those financial reports. You'll find your fixed and variable costs on your profit and loss statement, or you can even find them in your ledger accounts. Let's take a look at an example and I'll show you what I mean. Here we have an example of a profit and loss budget versus actual report. You may have seen something quite similar before generated from your own company's bookkeeping system. Your sales and expense accounts that your business uses will be listed, and their account balances for the period of time that you've specified the report to cover, maybe over the past year or the past month or even just the past week. Along the right-hand side, notice the different segments of the profit and loss report. They're labeled sales, cost of goods sold, gross profit, the individual expenses, and then finally your net profit. Remember these types of fixed and variable costs? Now it's your job to separate them on your own profit and loss statement. Why should you be so interested in fixed and variable costs? Well, for quite a few reasons, actually. The first and foremost, so that you can analyze what level of sales will cover your business costs. The break-even point is the level of sales at the prices you've chosen, at which total revenue equals total costs, and where there's no profit or loss being made. Understanding the break-even point can help you determine the minimum level of sales required to cover costs, and then after break-even, your business would move into the zone where it generates a profit with each sale. So what happens if your variable costs increase without you noticing for a month, or worse, for 6 months? Well, this can happen quite easily if your suppliers pass on their cost increases to you and you don't make an adjustment in your business. Your break-even point would increase. You'd have to sell more just to cover those cost increases, or you would have to increase your price to cover those cost increases. Understanding your costs is the basis of developing the strategic and profitable pricing strategy you're looking for. By taking a closer look at costs, calculating your company's break-even point, and monitoring your fixed and variable expenses regularly, you can find potential ways to reduce costs, improve your efficiencies, and set prices that achieve your targeted profit goals. There will be much more on pricing to cover costs in an upcoming chapter. Now that you're aware of fixed and variable costs and the nature of those costs on your prices, let's move on to the next topic in this Pricing for Profit video series, the impact that your market has on the prices that you charge. Welcome to this chapter of the video series, Pricing for Profit, where we'll take a closer look at the role your market plays in your pricing strategy. Well, it's pretty apparent that your costs aren't the only factor you need to think about when setting up prices in your business. Spend time to consider your customer, their pain points, and how your product and service offers solve those problems. If you can't clearly identify how you'll address the customer's needs, well, those customers simply won't buy from your business. So it pays to put yourself in your customer's shoes. Think about their pain points and what makes your product and services the right choice for them. Take some time to conduct secondary and primary research. Secondary research can be done through the World Trade Center in Winnipeg or Stats Canada or similar organizations. Understanding how many customers are in your intended target market, knowing that they have the disposable income that they can actually devote to purchasing from your business, that goes a long way towards establishing a sound pricing strategy. In addition, you should conduct primary research where you develop a set of questions and hear directly from your targeted customer base about their preferences, how your product and services compare, and any areas that your business can improve on. Asking for customer feedback about whether your products and services are worth the price they pay, that can really help you with your pricing strategy even further. You want to show how your business, its product and services, you as a business owner, and your staff as a team are all unique and different from your competition. The reason your customers buy from your business, why they're loyal, and why they want your offers, well, that's the basis for differentiating your company from your competitors. Analyzing the ways that you can stand out from the competition, then developing the messaging to market to your best customer groups and choosing the channels that they pay attention to, that's the job of your marketing strategy. Charging the price your customer perceives as good value for your offers, that's the key. And it all starts with understanding the competitive landscape that your business operates in. We'll take a closer look at this competitive analysis in Chapter 3 of the video series. Thinking about your customer's point of view and their perception of your product or service value are additional layers that affect price points that you develop in your business. As we've seen in this video, setting your prices isn't just about covering costs. Customers are often willing to pay higher prices for offers that address their specific needs or solve their problems and pain points. As customers get to know, like, and trust your company, its brand, and the value that your company consistently provides, you can justify higher prices and will find increased overall demand in the marketplace. Assessing the factors like this will help you set the price. If you're run off your feet with too much customer demand, well, maybe your prices are just a little too low. You're a wanted commodity. If you aren't getting any traction on new product or service lines, do you need to do more marketing or incentivize the early adopters to purchase, provide education or a discount, or add an extra bonus value to your offer? There's so many things to consider when you adjust prices to suit your market. Now, join me for the next module, Chapter 3, where we take a closer look at how to analyze your competition when developing your marketing strategy and your pricing. Welcome to Chapter 3 of the Pricing for Profit video series. You know other companies in your geographic region or in your online space that you'd consider your competition. I'm sure you could make a list of them right now if you needed to. Why not take that knowledge, add to it, so that you can really evaluate what your competitors do well, where they're lagging, and how your company stacks up against them. I'll show you how. Let's walk through a competitor analysis together. To simplify and organize the information that you're about to gather about your competition, consider setting up a simple spreadsheet or a paper-based chart. You'll find a sample template that you can download and customize to your own business situation as one of the resources that accompany this video series. Listed on the screen are suggested criteria that you can evaluate about your competition. We'll take a closer look at each of these parameters in just a few moments. But first, I wanted to give you a preview of the competitor analysis spreadsheet template. Again, it accompanies the video series and is a blank copy ready for your research on your competition. It may seem a little daunting at first since there's so many aspects of your competition that you can look into, but by listing each of your competitors line by line, taking small bites out of this larger project, in no time, you'll see that you can fill in more than you originally thought about your competition. Okay, getting back to that list of key areas to focus on in a competitor analysis. After writing down the name of your competitor, you'll want to list their location details. Now, this can mean their physical location, but also where they interact with clients online. Do they have a website with e-commerce capabilities? And is that website easy to navigate? Do they have active social media accounts? Market presence could also come in the form of participating in trade shows, pop-up locations, community markets, or even home parties. All of these locations are important to list. It will give you a clear view of the many channels that competitors can use to interact with clients. Moving on to other criteria you can evaluate about your competition, listing the main categories that they have of products and services available for sale, plus any additional value-added extras that they provide customers. Those extra add-ons could be things like guarantees or loyalty programs and discounts, membership programs, or even free service that's packaged onto the products sold, like free delivery with orders over a certain level of sales. If it's difficult to find information for this part of your competitor analysis, creative research may be in order. Consider calling or even browsing competitors' store yourself. Online research on competitor websites or social media accounts often will yield good results. While you're recording information about typical products and services sold by competitors, notice the shipping options that they offer, their prices, and their overall strategy for positioning their price versus the value that's provided. Are they a high volume, low priced vendor, or do they position their products and services as higher value, intending to charge a premium price? You may be surprised to uncover the strategy that's used. But don't be surprised if you find that competitors have no rationale for the prices that they charge. They don't focus on their marketing. They don't know the value of their products and services, and they don't seem to cover their fixed and variable costs. And why does this happen? Well, I think we can agree that pricing for profit is a tough job. It's a tough topic. It requires effort, perseverance, analysis, constant monitoring. So developing sound pricing strategies is sometimes avoided, and instead gut feelings or simply undercutting the competition is what's relied on. If you find this approach is employed by competitors during your analysis, take heart. You are the one who's on the right path towards pricing for profitability. Stick with it and keep watching this video series. Let's move on to your competition's marketing strategies. This is where you again do research and notice the messages and the channels that your competitors use to drive sales to their business. Do they seem to have a strategy, or is it haphazard with a stop and start nature? What are their marketing efforts that they put into play? Looking at the social media channels that they're active on, do they have a large following? Who are they targeting with their marketing messages? And does their approach seem successful? Do they hold special events or sponsor charities? Do they get media coverage? Are they talked about on Coffee Row? And really thinking about any and all of these marketing evaluation criteria and more, that's what you can include in this section of your competitor analysis on marketing approaches. And finally, from all the research that you've collected on your competition, now is your chance to evaluate them by listing what they do really well and also where they miss the mark. Do they have amazing leadership and great service? Are they new to the marketplace and so they don't have a reputation and are pricing quite a bit lower than the rest of the competitors in your marketplace? Do they have longtime staff that have a ton of valuable knowledge and a loyal customer base? Also, list a few of the innovations or the opportunities that this company seems to be jumping into. Are they embracing technology, for one? Do they use certain apps that make them leaders in the field? Or are they bringing in new products and services to your local community that are a great fit for their existing customer base? And on the flip side, can you see any threats to those competitors from all of the research that you've compiled? Maybe those long-term staff, maybe they're getting ready for retirement, or perhaps their pricing strategy leaves no room for error and no room for additional profit. A competitor analysis can highlight the good, the bad, and the ugly. Monitor your competition regularly, and you'll find intel that will help you carve out your own company's piece of the pie. Okay, up next is chapter 4, where we will introduce a few pricing models and build on all that we've learned so far in the Pricing for Profit video series. Welcome to Chapter 4 of the Pricing for Profit video series, where we'll assemble much of the learning that we've done so far and summarize it into 2 different pricing models: cost-based pricing and market-based pricing. We're going to cover the advantages and disadvantages of each and how you may be able to use a combination of both to set your pricing strategy for your business offers. Remember those fixed and variable costs that we discussed in Chapter 1? We'll now revisit them in our first pricing model, the cost-based pricing strategy. On this slide, you'll find the steps that I suggest when taking the cost-based pricing approach. Step 1, because your product and service offers should have a variety of prices, you first need to define which category of products and services to start with and calculate the price for. Then step 2 and 3, determine the variable costs that directly relate to producing or acquiring that product or service, and calculate the fixed costs or indirect costs that must be incurred regardless of how much your business sells, and apportion those fixed costs based on percentages to that product or service category. If you recall from Chapter 1 of the video series, your bookkeeping expense accounts can often be separated quite easily into fixed and variable categories. When you generate your profit and loss report from your bookkeeping system, these fixed and variable expenses will be summarized over the period of time that you want to examine, maybe over a week or a month or even a year. You'll see that variable costs are often found in the cost of goods section. They can be specific raw materials related to your product offer, direct labor costs, packaging, or freight costs for your product. Fixed costs, like the many overhead or administrative expenses that our business incurs, those can be found on your profit and loss report as well. Now, the key is to reduce both the variable and the fixed costs down into an amount per unit that you sold, maybe per item or per hour. You'll need to know how many of each product or service that you sold in order to do this calculation. And many entrepreneurs have remarked that this is a lot of work to separate out the costs that specifically relate to one of the products or services that are offered. And yeah, it really is. But you have these formulas highlighted on the screen to rely on, and your source document of your profit and loss report to also take a look at. Before we leave the cost-based approach, we need to talk about that very important step in the calculation. Step 4 requires we consider our profit goals. Make sure you include that profit per unit that you'd like to achieve. And why is that so important? Well, it seems logical, but we as business owners want to get paid and also build value in our business. Profits will do that, but even more so, profits can help your company expand, can cash flow new equipment purchases, they can fund a new marketing campaign, or help to hire new staff, or simply be saved for a rainy day. Don't forget to incorporate profit into every offer that you have on your product and service list. Now let's see this cost-based pricing formula in action. I've listed the formula on the top of the screen, and below it, I provided my t-shirt company example. I've looked at my bookkeeping system and determined that variable costs per unit of my t-shirt, the freight to bring it in, and the direct labor to customize the product came to a total of $11,132. I also broke my fixed costs down and took the portion that I needed to apply to the production and sale of my t-shirts for the month. That was $230. Then I added in my profit goal for this t-shirt, $10 per t-shirt sold, or $720 in total. And when I use the formula to divide this total cost by the number of t-shirts sold, I find that my price needs to be set at $26.14 per t-shirt. This cost-based pricing model is pretty straightforward, and you should have all of the numbers at your fingertips in your bookkeeping system. With this approach, you can make sure your prices cover costs and integrate a profit margin. But you can already see where the drawbacks are. This approach doesn't focus on external factors like customer demand, competition, or how you've marketed and branded your offers to increase their value in the marketplace. There's a very real risk that you'll either overprice or underprice if you rely solely on this method. Which brings us to another option, market-based pricing. This approach is based on the value perception that customers have about your product or service. Your cost to produce your offers isn't considered in this model. What is key to consider in the market-based pricing model? Well, first and foremost, you need to develop a strong value proposition for the product and service you offer. Your customer's perspective is extremely important. Identifying your customer's pain points, the benefits of buying your offers, that's the key, which we looked at in a previous chapter. You'll need to consider the best customer groups that you can sell to as well. Those that are the most attracted to your product and service offers. It's really important to this pricing model that your marketing message hit home and you tailor your pricing strategies so they'll fit with your customer's ability to pay. As we've covered in chapter 3 of the video series, you need to be clear on what your competition is doing in the marketplace, so that competitor analysis exercise is crucial as well. I'm sure you can guess some of the advantages and disadvantages of relying solely on the market-based pricing model. By charging what you perceive the market will bear, in theory, you'll know your market incredibly well. You can really be flexible with this type of approach, and you should be able to maximize your revenues. That all sounds absolutely fantastic, but, and there's always a but, this is a very subjective model and approach that requires vigilant market research. It has a margin of error as well possible, and your input costs aren't considered if you employ only this market-based pricing strategy. Okay, that's a look at the cost-based and the market-based pricing strategies. We're now ready to develop a pricing blueprint for our own business. And we're going to look at a number of simple pricing tactics that can be relied on in your business as well. So join me for that in the next chapter, chapter 5 of this video series. Welcome to chapter 5 of the Pricing for Profit video series. We've done great work to get to this point, and you're ready to create your own pricing strategy now. My suggestion is you consider your input costs, your profit goals, and the market when you set your prices. You've learned pricing fundamentals in these videos. Prices need to cover fixed costs, variable costs, and profit if your business is going to be viable. And you must know what the competition is doing, what they're charging, the value that they bring to the marketplace. Your own value proposition is important to know as well, and how customers perceive the products and services that you offer. Start with covering costs and profits, then assess the market and ensure that your prices are acceptable to your customers for the value they receive. Check in with your competition in the marketplace very often. How do you stack against them? Review and revise your prices as needed. By incorporating this hybrid approach, you'll be best equipped to price for profit and thrive in your business operations. Download the Pricing for Profit worksheet for guidance in working through this process, and stay tuned for some additional pricing tactics in the next video of this chapter. Here are some other tactics you can employ as you build your pricing blueprint. The first you can consider is using lost leader offers. They are priced at break even or a really low level and will pull customers into your business, enticing them to buy not only those lost leaders, but also the products and services that you sell that are in your lineup. Grocery stores often will use loss leaders. We've seen those bargains at the end of the bunk aisles that are just kind of too good to be true. This strategy isn't for every business, though. There's no profit to be made with a loss leader typically, but you can expand your customer base due to this tactic. Customers in your target market that hadn't bought from you before might come in and then continue to buy from your business in the future. I like this next tactic, bundling or packaging together a combination of your products and services. Restaurant owners know this one pretty well. Combos of appetizer, main course, dessert, and a drink all bundled together. It makes the consumer's buying decision easy, and it increases the perceived value for the price that they pay. This bundling technique can be done for almost any business. Brainstorm the ways that you can package your own offers, price them to cover costs and profit while still appealing to your customer as a great value. Do you have any products that you'd like to move? This may be a strategy to employ, encouraging multiple products or service sales by stating one for X dollars and two for a reduced price or a discount. Of course, that discount still needs to cover costs and create a profit, as well as appeal to your customer base. Perishable products may be a good fit for this tactic, or products and services that are trendy and are on the downward slope of their popularity. Or if inventory is high in your business, you want to free up that cash flow to use it for other business purposes. This tactic could definitely drive sales. We've all seen those prices that end in 99 or 97 cents, and maybe even felt the urge to buy that great deal ourselves as consumers. The idea is that customers will see $3.99 as $3 rather than the actual price that's much closer to $4. Using pricing psychology can work. In the case of the 99-cent ending, it seems to work for product-based companies more so than for those that offer services. Do a little extra reading on this topic of pricing psychology. It's pretty fascinating. Once you've worked out all the calculations and researched all the steps of pulling your pricing for profit blueprint together, you'll need to set up a process to monitor and evaluate the effectiveness of your pricing strategies. Collecting feedback from customers, regular check-ins with your bookkeeping system to assess your profit and loss reports, reviewing your outgoing marketing messages, and how you compare against your competition. Tweak your pricing strategies as you need to. Don't let time slip away without consistent and timely review and modification of your prices. Thank you for viewing the Pricing for Profit video series. We accomplished a lot. We looked at fixed and variable costs and their impact on pricing decisions. We discussed the concept of perceived value and how your customers and competition compare. Then we reviewed two pricing models. One was the cost-based pricing and the other was the market-based approach. And then how you can create your own pricing blueprint to ensure your business is profitable and thriving. A big thank you to Community Futures. Again, reach out to Community Futures with your questions about your business startup, opportunities, or challenges that you're facing. They want to help you reach those business goals. I invite you to keep in contact with Community Futures, continue learning, and making positive changes to your business. I'm Verna O'Neill, signing off and thanking you once again for watching the Pricing for Profit video series.